Welcome to our final presentation for Chapter 2, Mutual Funds, Investments for the Masses. Are you recovered from that previous presentation? Yeah, I know. This one's nowhere near as involved. We're going to take a look at some fund families and then some of the services and conveniences that are associated with mutual funds and some places we can research mutual funds. And then we're going to discuss, Payano, how do you pick a mutual fund? It ain't easy. So let's start with slide 62, fund families. A family of funds exists when one mutual fund, one investment company, one mutual fund company manages a group of mutual funds. Funds in the family vary in their objectives, and you can move your money from one fund to another within the fund family almost always with no charge. But if the fund is in a taxable account, the IRS is going to say, "Hey, you generated a taxable transaction." If it's in a retirement account, an educational savings account, no, you don't worry about the taxes until you take the money out of the account. Now, most fund families now have fees that are being charged for excessive transfers within the fund family. This is being done to discourage market timing by investors. And this is one of the things that the scandal of 2003 was about. People were moving their money back and forth between different mutual funds in the company, which is, that's not why you buy mutual funds. So now many companies will say, "Sure, you want to do that? Fine, we'll charge you 2%." And then that money goes back into the mutual fund. So go right ahead. You're just enriching your fellow mutual fund investors. Where other companies just won't let you do it. I mean, Vanguard, if you tried to pull that stunt, they'd say, "Look, go buy and sell ETFs, all right? This is not what mutual funds are about." One company, American Funds, if you do it, they'll warn you. They'll say, "Don't do that. Stop doing that." They'll talk to your financial advisor. And then eventually, if you keep doing it, they'll just say, "We don't want you as an investor anymore. Sorry, goodbye, go away." Yeah, so mutual funds are not meant to be trading vehicles, although we saw people with their ETFs are using their exchange traded funds, are using them as trading vehicles, and the mutual fund company doesn't care because it's the brokerage firms that have to take care of the trading. Now, Forbes said it best. I don't know, 25 years ago or so, 26 years ago. Choose a family, not a fund. I wish I had come up with that idea or that saying because it's a great saying. Look for fund families where most all of the mutual funds have done very well in good times and bad times over decades. So let's take a look at the 10 top fund families. Now, this information is very difficult to get a hold of. It's interestingly not in the ICI.org, the Investment Company Institute fact sheet, fact book, the 2021 fact book. So this is actually a little old. It's from a website called Think Advisor, but they say it's from Morningstar. If you go to Morningstar's website, you can't find it. So other sources have the top 10 listed differently. Some mistakenly add non-mutual fund assets to the totals. For this reason, you might see BlackRock as the number one mutual fund company. No, it is the number one money manager in the world, but Vanguard is a bigger mutual fund company. They have more mutual fund assets. BlackRock has mutual funds and they have a whole lot other types of investments. So Vanguard is by far the largest mutual fund company, and they have done that on the backs of their index funds. They've convinced people that active management can't beat the index, and yet they have mutual funds that are actively managed that they don't get rid of, like PrimeCap, which is an excellent group, by the way, PrimeCap. They spun off of American Funds back in the early 80s. And then Wellington, which has been around for decades too. And those are actively managed mutual funds. So don't let Vanguard wow you with their index funds. They also like actively managed funds. As we said, BlackRock is the world's largest mutual fund manager, but I'm sorry, world's largest money manager, but in mutual funds, they're number two, but they're not the largest mutual fund company. Oh, by the way, you're going to do some research on the thrift savings plan, right? The 401k plan for federal employees and military. BlackRock might be somehow involved in them. Think about it. The number one company for many decades was Fidelity. And my beef with Fidelity is they just have too many darn funds. They have hundreds of funds. And they're brilliant marketers. Like you go to their website and you can buy thousands of other mutual funds through Fidelity. So they made deals with dozens of other companies and said, hey, we want to sell your funds right from our website. They're very smart. And then you might have heard of American funds. They for decades, they never advertised. They're now starting to advertise under their original name, the Capital Group, or just people just call them Capital. But they were always known as the American funds. And now they're starting to advertise. But for decades, they never did any advertising whatsoever. They only sold through brokers. State Street Global Advisors, the spiders that we talked about. Briefly, we didn't really talk about that much, but that's the cool name, Spider. The State Street started out as a company that would be the custodian and transfer agent for your mutual fund. So you didn't have to duplicate those components. You could just go through State Street, and then they started their own mutual funds. So they're quite large. T. Rowe Price is a very good company, folks. They're based in Baltimore. Oh, by the way, Vanguard's based in outside Philadelphia. Where is BlackRock? BlackRock's in New York, right? Fidelity, Boston, American Funds, Los Angeles. Now, these companies are global in nature, folks. State Street, Boston. T. Rowe Price, Baltimore. They've been around for decades. Very good company. Check out their offerings. Invesco merged with Oppenheimer. They're based in Denver. I don't know where Dimensional Funds Advisor is based, but Invesco's got some very good funds, although they got a lot of stinkers in my humble opinion. Oh, don't sue me, please. Dimensional Fund Advisors. They are a very popular group with advisors and some very, very good funds. And I'm not sure where they're based. And then PIMCO, Pacific Investment Company, is based, believe it or not, in Newport Beach. But again, they're global in nature, these companies. They've had the distinction of having the world's largest bond fund for several years. But their bond guru ran away and joined Janus Henderson. Yeah, Bill Gross. We'll discuss Mr. Bill Gross later on. And then Franklin Templeton. Franklin Templeton is another storied company, been around for decades. They're based up in Northern California. They bought Legg Mason. Remember we talked about the Legg Mason Value Trust that was changed the name to the Clearbridge Value Trust, burying the evidence. And I didn't think that was the smartest thing in my humble opinion, but I'm not the CEO of Franklin Templeton, who's actually a woman, folks. The future is female. So check out these companies. Some are very good, some are not so good. I won't tell you who my favorites are. You decide who your favorites are. But don't be swayed by the advertising, all right? Look at the numbers. Show me the numbers. Slide 6. Oh, by the way, in the face-to-face class, we would throw up on the screen the offerings of Vanguard and Fidelity and American and maybe a couple other companies. And just show you the hundreds of Fidelity alone has hundreds of choices, and then if you flip a switch on their website, you get over 10,000 funds that you can look for. It's just a sip from the fire hose. Another company is not in the top 10 that deserves your attention is called Dodge and Cox. They've been around again from the 1930s, but they're really strange. They're based in San Francisco, and they are absolutely awesome. But, San Francisco, you think, very urbane and sophisticated. And then you watch their videos. They have wonderful videos about what they believe are trends in the market, how they're investing and the like. And these people look like they're from Omaha or Kansas or someplace. I'm not trying to disparage people from the Midwest, but they look out of place in San Francisco. But anyway, who can argue with their results? They only have now, I think, 6 funds. 6 funds, where Fidelity has 500. So they've taken a very different tack. They've been around since the same time, the 1930s. So let's take a look at that's part of your assignment. Part of your assignment is to go out and investigate at least 2 mutual funds. More is better. Hopefully you'll get hooked and say, oh, let me look at this one. Let me look at this one. Oh, boy. And that's your part of your assignment. And then you're going to research also the thrift savings plan. Slide 64, automatic investment plans. These are mutual fund services, sometimes called dollar cost averaging, systematic investment plan. I wish I could come up with a better name, because systematic investment plan, automatic investment plan sounds so sterile. And dollar cost averaging, even though it's absolutely awesome, it's not a very good name. Another name is to pay yourself first. Automatically send fixed amounts of money, $50 a month, $100 a month, more if you can afford it, from your paycheck or your checking account. In my humble opinion, this is the absolute best way to invest in a mutual fund. You don't have to worry about whether or not it's a good time to invest. Every month is a good time to invest $50 that comes right out of your paycheck or your checking account automatically, and it's practically the only way people will ever invest. And remember, we said we want to do our best to remove emotions from our investing. As Mr. Bogle says, it has no business being in your investor toolkit. And this is one of those ways to just not even worry. If the market's high, oh well, there's $50, $100 goes in the market. If the market's low, oh well, I'm getting more shares. Yeah, it's part of our toolkit to help us eat reasonably well and sleep reasonably well. Slide 65. Automatically, unless you say otherwise, the mutual fund is going to reinvest any capital gains, dividends, interest payments. The automatic reinvestment plan. This is the default mutual fund service that enables shareholders to automatically buy additional shares in the fund through reinvestments of dividends, interest, and capital gains. Automatic reinvestment plans allow an investor to earn fully compounded rates of return. Unless an investor needs the income, it is always a good idea to reinvest dividends and capital gains received from mutual fund. By the way, as we said, automatic reinvestment of dividends, interest, capital gains is the default when you open a new mutual fund account. Now, here's the best part, the systematic withdrawal plan, the automatic withdrawal plan. This is the service that enables the shareholders to automatically receive a predetermined amount of money, monthly, quarterly, annually. Normally, you set it up so that it is transferred directly to your checking account. Why have them bother creating a check, sending in the mail, and you haven't deposited? It is done electronically. Now, think about this, folks. You're young. You're going to start putting $50, $100 a month away for 40 years. And hopefully you're going to take a look at the hypothetical investments. We'll talk about it a little bit later. And then for the rest of your life, you withdraw $2,000 or $3,000 or more, because you're going to keep putting more money in, right? For the rest of your life automatically. Now, is that a deal? Is that a deal? Even though we haven't come up with a really good name for it, you're going to turn your investments into your own pension plan. Or maybe you'll use it to buy a house or whatever. But this is so cool. Mutual funds are just so easy. The PETA factor is very low. Now, the conversion privilege, we already talked about that, the exchange privilege. This allows the shareholders to move money from one fund to another within the same family of funds. If you do it in a regular account, it's going to trigger tax consequences. But if it's in a retirement account, there's no problem. So when you think about it, you start off in your 20s and 30s, you're going to be investing fairly, hopefully not too aggressively, but maybe growth in income. And then when you get to be in your 50s and 60s and 70s, you're going to want to be more conservative. So you're going to slide down the risk versus return spectrum. Some people call it the glide path. And the cool thing is, if it's in a retirement account, you don't get hit with any taxes until you take the money out, unless it's in a Roth, and we'll talk about those later, much later on. Then you don't hit any taxes. If it's in one of those target date funds, it happens automatically. So this is very good. Mutual funds are very convenient, and the services are awesome. Now, how do we purchase our mutual funds? Well, we talked about this already. Closed end ETFs, you do it through the stock exchange through your broker. Open end, you do it through a broker directly from the investment company. And my humble opinion, the best way is through auto contributions from your payroll and your checking account. The sell options, if you have a closed end or an ETF, you have to do it through the stock exchange. If it's open end, you go through your broker or through the mutual fund directly. And the best way is automatic withdrawals. Sounds kind of boring, isn't it? Yes, mutual funds will bore you to wealth. 68, taxes. Oh, darn. Why do we always have to talk about taxes, folks? There are two types of taxes for regular accounts. There are the income dividends and then the capital gains distributions. It used to be the income dividends were taxed as income, but that's changed since the 2003 or so, four. That was Mr. George Bush the Younger's big contribution, and it's helped immensely for very wealthy investors. So the taxes on your income dividends and capital gains distributions are much less than what you pay for your income taxes when you earn income. The reinvested dividends and capital gains are still taxable transactions. So save your year-end statements. And people get angry about this. Maybe it's a down year. Market's down, their mutual fund investments down, maybe 10, 20%. And then they get a 1099 in the mail in January saying they got to pay taxes on some capital gains distributions or income distributions, dividend distributions. Wait a minute, I lost money. And then they complain to their congressperson who says, well, maybe we'll change this up. We'll make it so that unrealized capital gains, paper profits, would not be taxed until you sell your... Forget it. It's not going to happen. It would be an unbelievable nightmare. It would keep the accountants busy forever and a day. Tax code's already difficult enough. So just pay your taxes and don't get upset. I mean, taxes are the price we pay to live in a civilized society. And at first, it won't be that much money. Maybe $10 that you have to pay extra. When it becomes a serious amount of money that you're paying in taxes, congratulations. That means you're doing really well. And I don't feel too sorry for you. In fact, I hope you have that horrible situation later in life that you're paying too much taxes, because that means you're very, very wealthy. I certainly would love to have that problem too someday. Tax-deferred retirement accounts. Well, as we said, if it's in a tax-qualified, that's what the IRS calls them, tax-qualified account, you don't pay any taxes until you take the money out. But if you have the Roth option, a Roth IRA, we put it in quotes, Roth 401k, Roth 403b. It's not their legal name, but those are after-tax accounts. If we do what we say we're going to do, wait until 59 and a half and then retire, you don't pay any taxes on those. Very, very cool. Okay, so that's taxes. Get that out of the way. Now, where do we go for information? Slide 69. Well, the first place you're supposed to go, and as we said, nobody reads these things, is the prospectus. It's a statement describing the risk factors, the description of the fund's past performance, the type of investments, the information about dividends, distributions, taxes, the fund's management, the fees. Take a look at one of the prospectuses. Take a look at the prospectus for the company you're investing in. See if you can find the description of the fees. No one reads them. It really isn't that hard, folks. So go through it, and realize that it's very useful, especially not the summary one, but the full one. If you have insomnia at night, just curl up with one of these prospectuses, and you will fall fast asleep. The mutual fund annual reports, these can be very useful. In fact, they are similar to the prospectus. The scary stuff that nobody can read and discern, that's the most important stuff. In the front, they'll tell you why they did really well or how they did really well and review. And some of them will do their best to not explain how badly they did. They'll put their best foot forward, but that makes sense. Some are sparse, some are chock full of good information. So hopefully you will curl up with a mutual fund annual report and fall fast asleep. But we want you to go through at least 2, okay? At least, hopefully more. See if you like it. And realize, we'll discuss this when you listen to the commentary for the assignments. The information that you're researching is not as important as your experience. We want you to analyze your feelings, your thoughts, your joys, your pains as you do this. Because one of the things that we must learn about ourselves is, are we really cut out to be, retail investors, choosing our own stocks, bonds, other types of investments? Or are we better off choosing mutual funds and letting the professionals do it? And neither is good nor bad. I'm not trying to say if you don't enjoy this and you absolutely would rather do anything else than research companies and research mutual funds and the like. I'm not saying that's a bad thing. It's just important to know, because it's not, it's not for everyone. It really isn't. If you enjoy it, you're probably going to do pretty well at it. You're going to make some mistakes. You're going to make some faux pas, but you're going to do some things really well. You're going to do many things well. You're going to do a few really well, and you're going to be really proud of yourself for that 1 or 2 or 3 investments that just exploded in the upside. But you'll always remember the ones that didn't work out so well. Actually, we'll discuss this later on. We're hardwired to forget our bad experiences. So many people will forget that they bought a stock for $11.88 and then sold it for 30 cents. I have a hard time forgetting that because I keep reminding you that I did it, but I just want you to remember they're out there and you're going to make some mistakes, and don't beat yourself up for it. Okay, so what about financial publications? Well, we talked about Morningstar and Lipper. They're both pretty good. I sometimes get angry at Morningstar because of that style box and some of the other things that they do, and sometimes they blow it. They put a stock in the wrong category, a mutual fund, I'm sorry. They put a mutual fund in the wrong category, and then, for example, there's one fund that is, it's not really an emerging markets fund, but it's lumped in with the emerging markets. And then when the emerging markets do really, really well, because this fund also invests in the developed markets, it will be at the bottom of the list. So they give it 1 star. They say, oh, it's a poopy fund. Then when the emerging markets become submerging markets, this mutual fund company holds up really well and is at the top of the list, and they give it 5 stars. So come on, give us a break. So that's my bugaboo with Morningstar. But they're very very profitable and popular investment advisor for mutual funds. They've also branched out into stocks. Business Week, Forbes, Kiplinger's Personal Finance, U.S. News and World Report also has a big issue devoted to mutual funds. And these mutual fund surveys in these publications, again, you got to be careful. You have to do a whole lot more research than just picking the one at the top, because sometimes the one at the top next year is going to be the one at the bottom the year after that. So be careful. The financial websites, Morningstar, Business Week, finance.yahoo.com, it used to be really good. Now it's not so good. And then my favorite is to actually go to the mutual fund companies' websites themselves. When the internet was exploding 25 years ago, some of these companies made fabulous websites. Vanguard had what they called the Investing University, or the Vanguard University or something. It was great. I thought it was fabulous. And then in the 2000 to 2002 bear market, they took them all down. And I guess they must have got yelled at by the Securities Exchange Commission. I don't know. But now they are promoting education again. Check out T. Rowe Price's American Funds. I don't have that on the list, but they have a really good educational. Dodge and Cox, Franklin Templeton, Fidelity is good, and Vanguard. Oh, Capital Group. That's American Funds. The Capital Group. They're changing their name. These companies have excellent educational materials on their websites, and of course they're trying to put their best foot forward. They're hoping that you'll choose them as your choice of mutual funds. But I'm sure that these are all good companies, folks. So don't get me wrong, and I'm sure that they want you to do your best. They want you to be prosperous, and if you're prosperous, they'll be prosperous too. And then the mother lode, as we said, is the Investment Company Institute website for those of you who'd love to dig deep into the statistics of the investment company universe, ICI.org. You're exhausted, aren't you? I am, I know. Oh my goodness. I told you, picking the mutual fund is the hardest part. Once you've done it, once you've picked the mutual fund, you let it ride, because it's a long-term investment. But until then, you're not alone. How do I pick a mutual fund? Well, as we said, it ain't easy, right? There's a lot of good choices, a whole lot of bad choices. Here are my pieces of advice for what they're worth. Pick a mutual fund that invests in high-quality stocks or bonds. Well, there you go. How do you define high-quality stocks or bonds? Everybody, quality like beauty is in the eye of the beholder. Is well diversified across several industries and sectors of the economy, preferably globally diversified. Has a long-term perspective and a manager, or better yet, in my humble opinion, a management team with many years of experience. Not a committee. A committee, everybody has to decide on a single choice. You want a team where they work together, but then they make their own choices. Very good system. It's been around since the late 1950s in certain companies. You want to avoid companies that shuffle their managers like a deck of cards every few years. And this is what Fidelity was famous for. In fact, the guy who started Fidelity, he was right up straight about it. He said, look, this is the way we do business. If you're good, you get to stick around and get showered with love and attention and money. And if you're not so good, you're out the door. But what does that do? That encourages, these people are not stupid, folks. It encourages the mutual fund managers to take undue risks because they know if they don't do well, they're out of there. And if they do well, they get to stick around. So obviously, that wasn't always in the best interest of the mutual fund investors. It worked great when you chose a Peter Lynch, but it didn't work so great when you chose good old what's-his-face, is gone after 2 years. And then, most importantly, in my humble opinion, you want a mutual fund that has been around for decades and performed consistently well in good times and bad times. People tell me, look how well this is done during good times. I'm not interested. I ain't interested. I want to know how well you did when the organic matter hit the ventilating device. Because it's going to happen. We know it's going. We don't know when, but we know there are going to be market downturns, crashes, panics, corrections, whatever you want to call them. And I want to know how you did when that happens. Because that, it turns out, is a hallmark, is an attribute of mutual funds that have done well over decades. There was, I forget the study, I got to go find it. But they found 3 characteristics of mutual funds that have stood the test of time. One was they have lower fees than the industry averages. So instead of 1.5%, they had 0.6% or something like that. They had mutual fund managers that owned the mutual fund. In the industry, we call this eating one's own cooking. So they had mutual fund managers that had substantial investments in the mutual fund that they're managing. Well, duh. If you're investing in this thing Don't you want it? And you're the one running it. Don't you want it to do well? Yeah, right. And then third, they had a history of holding up well when the markets fall. Don't lose the money, right? Knowing full well that there's going to be times when you're going to lose, but we want to avoid large losses. So here we are on slide 73, a sample stock mutual fund. And we use a mutual fund company called the Investment Company of America, ICA. It's been around since 1934. Actually, it's been around longer than that. And on the website in Canvas, there are ancillary presentations and PDF files, documents that we want you to take a look at. Because this fund's been around for over 87 years. They start the clock in January 1st, 1934, but it predates that. I think it started in 1926. So is that long enough for you? 87 years? And remember, we said 8, 9, 10%. These guys have done 12%. Now, I'm not trying to sell you ICI. Don't run out and buy ICI. You're buying ICI. We need to look at one mutual fund, and then you're going to look at a few more, but we need to start somewhere out of the 12,000. And what you'll see that, yes, in the short term, stocks are risky. There's no way to get around that. But if we take a long-term perspective, it turns out that unless the world ends, we've done pretty darn good, folks. And those times when the market has fallen have been the best times to invest. The worst times to invest are when the market's doing really, really well. Ooh, is it too late to get in? Yeah. Ooh, is it too late to get out? Yeah. Take a long-term perspective and things should do well. So if you hear people say now is not a good time to invest, it's usually because it is a good time to invest. And really, when does it ever feel like it's a good time to invest? When the nightly news is talking about the end of the world and there's floods and tsunamis and global warming and disco may return. But if you had gone back 20 years, and it was one of the presentations, and picked the worst day to invest, as opposed to the best day to invest any 1 year, he still did pretty well. Okay, so we find a mutual fund that's similar to ICA or the like. Actually, I don't normally recommend this one. Why? Because it's domestic in nature. For younger folks, just starting out from a clean sheet of paper, I believe global is the better way to go, but that doesn't mean it's not a good fund. And again, I'm not trying to sell it to you. I'm just saying we got to concentrate on one. What about, so watch those presentations, look at the documents, see how well this one mutual fund has done, and realize that there are many others. What about market downturns, folks? It doesn't feel good. It feels horrible. Everyone will tell you that it feels like somebody kicks you in the gut. The best investors are the ones that don't even notice. So I didn't even bother looking. I said, great. Oh, that's great. Keep a long-term perspective and use what is called dollar cost averaging. Dollar cost averaging is a horrible term. I've racked my brain to come up with a better name. Systematic investment plan, automatic investment plan. That sounds so clinical. It's a system of buying an investment at regular intervals with a fixed dollar amount. $50 a month, $100 a month. People say, well, I want to wait until I have $10,000 to invest. Wrong. When's that going to happen? Well, I don't have any money now. Well, how much is your cell phone? Oh, it's $80. It's supposed to be $50, but I download a lot of ringtones. Get started now. Now, some of you are 18, 19 years old. You got bills to pay with the schooling and everything. Don't worry about it. But that magic number, 25, 30 years is when 25 years old, 30 years old, you want to get started by that because by then you're, hopefully some of the young exuberance is bubbling out and you can settle down a little bit. I'm not trying to say you should get to the rocking chair at that point. But at least you got to realize, I've been spending $100 a month on my cell phone. Maybe I should be paying myself first. And the cool thing about dollar cost averaging is that no matter what happens in the morning, when you wake up, there's always good news. I had to convince my wife when I first met her because I was investing and she was terrified, which, good. That's good. It's good to start from that point of view as opposed to starting from, I'm going to make $1 million in 3 months. Woo, woo, woo. The market's up. Good news. I told her, Anita, because that's her name. No matter what happens tomorrow, there's good news. The market's up. Yay, yippee. Your $100 is now worth $100.25. The market's down. Good news. Huh? What? Wait a minute. That doesn't. Yeah, it does. Think about it. Next month, you will get more shares at a lower price when the $50 or $100 comes out of your paycheck or checking account. Right. When do you want to buy things? When they're on sale. That's not the way the stock market works, folks. People wait until it goes up 100%. Ooh, time to get in. And then when it goes down 50%, let's get the hell out of here. By using dollar cost averaging, and I don't want you to memorize this, but eventually I will when we get past stocks and bonds and look at it the semester from the rear view mirror. Your average cost per share should be lower than your average price per share. Huh? Well, you see, by putting in the same amount of money, investing the same amount of money, when stocks are high, you're buying fewer shares. When stocks are lower, you're buying more shares. So your average cost per share should be lower than your average price per share. Don't worry about the numbers. We'll do it later. It's not a guarantee. No, there are no guarantees. Dollar cost averaging is not going to turn a lousy investment into a profitable one. But it's about the only way that most of us will get started. Really, I think so. So, slide number 75, hypotheticals. Most mutual fund companies have a system for running what are called hypotheticals. Now, you have to talk with a licensed individual because they're the only ones who are allowed to run these things. They go by the name of illustrations, hypothetical illustrations. They're very popular in the life insurance world. They are examples of returns of investments in the past. They are not guarantees of what's going to happen in the future. Lump sum investments or a stream of investments, a series of deposits, a dollar cost averaging investment plan, or the combination of both. They must be approved by the Securities Exchange Commission and the Financial Industry Regulatory Authority and contain disclaimers about past versus future performance. These are not guaranteed, nor are they deposits or a bank or any other entity, so you may lose money. All kinds of stuff that nobody reads. In the face-to-face class, we would now run some hypotheticals, take a look at them. They're already done for you. They're on the website. They're in Canvas. Please don't blow them off, because if you're still worried about making money in the long term, I hope these hypotheticals will show you that, yeah, it's possible. In fact, it's probable, unless the world ends, in which case it doesn't matter where your money is. So do take a look at these hypotheticals. And if you are so inclined, if you'd like to see, well, how about if we did $200 a month for 30 years? Just send me an email, contact me, and I'd be happy to do it, because as I've told you, I can talk about this stuff a whole lot longer than any reasonable person would ever want to listen. Right. Now, I told you, I'm not trying to sell you ICA, Investment Company of America. Here's slide 76. That ain't the only mutual fund that's done well over decades. Here are about, 24 of these things that have been around 50 years or longer that have at least 10% returns. These are companies that we talked about. There's Dodge & Cox, there's American Funds, AMCAP, American Mutual Fund, that's Capital Group, American Funds. There's Fidelity, look at Contrafund, and Magellan. Now, I shouldn't include Magellan. This is a bad thing to do, Payano. I keep telling myself, get rid of it. I didn't include it for a few years, and then I put it in, and now I regret it. Because people are going to think, I want Fidelity, Magellan. No. The reason it's 16% is because of Peter Lynch back in 1977 and 1990 doing 29% a year. There's Franklin Templeton, Invesco. There's the company we talked about. It used to be Oppenheimer. There's MFS. This is the nation's oldest mutual fund company, by the way. Massachusetts Massachusetts Fund Service. I forget. MFS. They're based in Boston. Boston was the hotbed for many of the mutual fund companies for many years. Fidelity, MFS, Putnam. T. Rowe Price. Remember we talked about them? Excellent company based in Baltimore. Dreyfus Fund is now part of Bank of New York Mellon. It's now called the Bank of New York Mellon Large Cap Fund. But what was his first name? I forget. Mr. Dreyfus. He was a really, he's long since passed, but he was a very phenomenal investor back in the 60s. And then the Templeton Growth Fund, part of Franklin Templeton. There's Vanguard's Windsor, Wellington Management Company runs their Windsor Fund. And then another American funds, Washington Mutual. So am I trying to sell you these funds? Actually, no. Again, especially if you're younger, most of these funds, by virtue of the fact they've been around so long, are domestic growth and income or growth funds. And it's not that I have anything against the United States. I have several funds that invest mostly in the United States. But if you're starting from a clean sheet, you're starting right from the scratch, in my humble opinion, a global growth and income fund is a better choice for most people. That's what I recommend. But there are many good choices out there, many bad choices. Cool? Look at this little puppy here. 13%. Oh my goodness. Contra Fund, almost 13% since 1967. These guys have done 13% since 1956. Now, if you look at their volatility as measured by standard deviation, and if you want to, take a look at the T. Rowe Price Small Cap Stock Fund. See their volatility, because small companies are much more volatile than large companies. But take a look at that, and then maybe compare it to their growth stock or their New Horizons fund. T. Rowe Price is a very good company. I don't get any kickbacks, folks. I'm just telling you, these are companies that have stood the test of time. There are many other great choices. Don't get me wrong. Maybe these are not in your 401k plan or your 403b, so you're going to look at others. Maybe you're in the military or federal government. You got to look at the thrift saving plan choices. But they're out there. There are many good choices out there. Oh, by the way, all of these are actively managed. Don't let people tell you that actively managed funds can't beat the indexes. They can. Some of them have done it for decades. But here we pull the rug out from under you. Slide 77. What about the investors? What types of return do many typical mutual fund investors earn? What? Wait a minute. How could mutual fund investors not earn the same returns of their mutual funds? Well, it's easy. Right? It's very easy. Many typical mutual fund investors buy high. Ooh, is it too late to get in? And then sell low. Ooh, is it too late to get out? So in the industry, it is generally regarded, and it's already been shown. This is the famous Dalbar, D-A-L-B-A-R study through the Investment Company of Institute. Many mutual fund investors do worse than the mutual funds they invest in. They go to the 403b meeting. They see that the aggressive growth mutual fund has done 13% over 10 years or 18% over 10 years. They put all their money in there. The market falls 40, 50%. They fall 60%. They take it out, put it into the money market fund because that's where they were told it can't lose money. And the market bounces back 40%, 50%, 100%. And they say, okay, it's okay to invest now. Take it out of the money market fund, put it back in the aggressive growth fund. See, let's take a look at this. I apologize. This is not the Dalbar study. This is a different study. My apologies. But look at what happened. In 2000, the market had gone in two directions since 1982, up and way up. And so people just started throwing money after money, money. This is percentage of total net assets. These are inflows into the mutual fund industry, the green bars. The yellow bar is how well the market did. And notice 2000 was when the market turned and fell for 2.5 years, from March of 2000 to October of 2002. And it took a few years, but finally people realized, oh, it's too, get out of here. How do I get out of here? And then we see them plummeting, the inflows plummeting in 2003, just as the market zoomed back up again. And so what did people do? Like moths to the flame. They put their money back in the market. And then when we had the crash of 2008, they pulled their money out of the market at the worst possible time. The market skyrockets back up. And it isn't until 2013, 14 that people actually start, net inflows become positive. So all this time, when they should have been putting money in because the market was low, they were pulling it out, and they put it in after 2013 when the market had done very, very well. And so this goes up to what, 2018 or no, 2015 or 2015. So that only goes up to 2015. So you see, the most mutual fund investors do worse than the mutual funds they invest in. So what's the bottom line of mutual funds? Choose a fund family, stick with them. Reevaluate your mutual funds periodically. Once or twice a year is good enough, folks, really. But make changes judiciously and sparingly. As you approach retirement, migrate from stock funds to bond funds, but don't give up on stocks entirely. In my humble opinion, a balanced fund is an awesome choice for people in retirement, assuming their health is good and they have they look at their health, because then and look at the health of their parents and their grandparents, how things are going. Because you don't want to give up on stocks entirely in retirement. We're going to talk about this more in detail. People are living 30 years in retirement. But for the most part, just put $50, $100 a month away, more if you can afford it. In one of the hypotheticals, we're going to see putting $100 a month away for a year and then putting $110 for the second year, 2 fewer trips to $5. I'm sorry, 6, 10, but for Starbucks, 2 fewer trips to Starbucks. Next year, $120. Next year, $130. But for the most part, forget about them. That's why you're buying mutual funds. Somebody else is doing your investments. Do not be one of the mutual fund investors that does worse than your mutual fund. And that is our discussion of mutual funds. It's a lot to learn, folks, but you are going to be the investment guru for your friends and family and colleagues, and you can't let them down. And guess what? Oh boy, we're ready for stocks. Exciting stocks, sexy stocks, risky stocks. See you in our next chapter. We are so, so proud of you. Thank you so much for being in our class.